All right. Hi, everybody. And I want to, this is one of the most important videos that I'm going to do on trend. It's extremely um, important that you understand this is the reason why many people lose money. And so it's important to understand the aspects of the market that we're going to go over today. So I'm going to show you a chart, and we're going to go through the aspect of the trade almost by bar, and then we'll speed it up a little bit, okay? So let's do that, and I'll share my screen, and we'll begin, okay? So this is in Europe, and this is the 2 o'clock opening in Europe. And we see the strong volume that comes in. And generally in Europe at 2 o'clock, when the markets open, volume increases. It's true in the U.S. markets as well as in Europe and Asia with the opening prices where people put trades in. So since it's a mid-range close, we are going to put the trade, the line above here, because that's where the market got selling from. Since the bar beforehand here is the next larger bar, we're going to put that bar here because we don't know exactly where that is. I should probably not jump ahead too much, right? And we have this type of aspect of the market. That's kind of our rough guesstimate of what our trading range could be. Volume is not going to be high overall, but so be it. If we continue our journey, the market's in a trading range, building spacing, building cause as market goes in, and we start to see selling. That selling poor closing range doesn't give us an advantage as we go forward. We continue to go forward. We see the lack of buying here, which leads to more markdown. So now with this aspect in the morning in Europe, we see selling against resistance, a retest selling and weak demand to the market. We then get this aspect of volume increases. It's relative to the areas the market trades in. It's relative to market trades in. So the market comes selling, and now we're looking at this aspect of selling, and we're looking at three aspects. One, about halfway in the range, the LPSY area. Two, a retest of the breaking of the ice. Three, about halfway from markdown to the aspect here, which we haven't really gotten about halfway back yet. Okay, so we are going to mark LPSY. In case we get there, we are going to mark this as ice support. And we are going to look at the market, and now we have a bearish background to the market. We're not looking for the buy side at all until we see changes of behavior. Market continues on through Europe's 4 o'clock. Market now has a rally. Forget the volume. We'll just watch a price action. We go higher. We go higher. Now, we marked these. Remember, we marked this previously before the market began to rally. We don't know how far this is going to go. And we're looking for markets to sell. Well, our first aspect of the ice area. Well, this is strong. We're not going to sell that, right? We need to see some ending action, after result, or some action that's stopping action. We don't see that. So we let the market unfold. Boom. Now we have something that's very important. We have a shortening of the upward thrust into the LPSY area. Why here? The LPSY area is about halfway between the high and the ice support. When we see this, let's just extend this line as a guide to us. It also is resistance too, but it's also a guide in the area. And now we turn down from there. Shortening of the thrust. Why? Same volume, small range volume, small ranges, same volume. Effort versus result. Effort versus result. Next bar here shows a wider bar, and most people think this is that's stopping action to the downside. In fact, the market is preventing, is almost like a bag holding reverse. The market is prevented from going to the upside to the market. So in other words, the market looks like it's holding, but we don't really have buying in the background. So you have an aspect of where it's being sold, but we don't really know exactly that yet, right? So let's just look at the market as an unknown market, even though some character of volumes there, we'll have to see. I am now going to extend my range from here with a reverse trend line. And voila, we follow the access line to the market. Access line to the market. And it fits in perfect. Okay, a shorting of the thrust into an access line. LPSY fits like a glove. Better than O.J. Simpson in the trial, right? Market then turns down. Market turns down. The volume is heavier to the downside than to the upside. Volume is heavier. Red is the down volume. Green is up. Mark comes back down. Mark comes back down. Tries an attempted rally. Back up. The volume of the green to the up is still lighter than the red, right? This is what? What's this right here? This is the LPSY. This is how LPSY acts. A quick jerk down when the up move is over, down. This also is a shortening of the thrust right here, which caused that rally. Now, the axis line, which extends, as well as the horizontal line. So this is far away from the overbought area. And now it fits in perfectly to the LPSY, right to the glove. You don't know this is not going to break hard from here. Usually LPSY has a much harder break from resistance. So this was suspect. This is not a suspect. This is LPSY example. This is how LPS perfectly trades. Mid-range, down, hard, increasing volume. LPSY is the end of the up market in a bearish market. Now we have what? We now have a situation where supply is in control of the demand and of the markets. A very important aspect to what happens because we want to be able to trade the market in the trend of the direction of the day. Part of the story was the selling. Part of the story was a weak rally. And the end of the story was the LPSY break. Beginning with stopping action, breaking, a retest, overbought axis line, LPS area, did not have the hard break, a retest because we didn't break hard, and now the break hard. Now rallies should be sold. Rallies should be sold. We look for avenues of rallies to be sold. Okay. We now get a situation where the market has a short of the downward thrust. So we see now that market can react from there. We're not buying that market because there's no cause and the market is down. We're not buying it, but we can get a reaction from that area. Keep in mind, so short-term traders, you liquidate. Long-term traders, you hold on to it until you get demand. Goes higher, goes higher. Now, we have a possibility of a double bottom spring. Coming from weakness, we don't want to take that as a position trade. And maybe sometimes you could scalp that market, but certainly you don't want to get involved in a market that is in a situation to where it's bearish and you're scalping alongside, because the problem with that is that you get caught, you get hurt. Goes down, a spring. Okay? So from the end of the action, as a result, we get a spring. We have a little cause built here, right? A little sideways here. The question is accumulation or distribution? It's probably not accumulation because you don't have the buying, but you can get a rally from short covering into the markets. Let's see if we get one. We do. Short and thrust. As long as we maintain the structure of this area being resistance, the market is forming a lower trading range, which most likely is distribution to the markets. This is a 15-minute chart. Market forward, weak demand, reverse absorption, a spring possibility. Do we buy this spring? We don't buy this spring. As a scalp, maybe. As a position, absolutely not. No indication. It's the problem of trying to buy a spring in a down market. The trend of the market's intact. The background's intact. We do not want to buy a market spring from weakness. This is a perfect example of why we don't buy springs in downtrends. People say, well, Gary, the spring is the spring. It's not. It depends upon the parameters of the market. Goes here, shortening of the downward thrust. Expect some type of rally into the area here. We now form the LPSY again in this second area about halfway back. That's your second LPSY. Looking for an area to sell within this range. So recapping, market proves that it's bearish. Here's the whole story. Market background, selling, lower highs, lower lows, stopping behavior, selling, weak demand, a grind higher to the market, reaches the access line, does not get supply. That allows a secondary test. Now selling is coming in more earnest. Look at the volume. This is more severe of a break than this was here. This was very grinding. This was more direct. Market comes back up. A retest of the LPSY area, or the LPSY area. I'm sorry. This is the retest of, of the resistance gives you selling. This volume does not high enough to be climactic selling, cause a retest. 1, 2, 3, 4. 4 bars retrace 2 bars. Weakness, weak demand, weak demand, weak demand. And this is a current chart. We still have weakness with no ending action to the market. It's an example of why you don't buy springs and downtrends, why you identify the day if you're intraday trading as quickly as possible. If this was a day chart, it gets traded the same way as a short-term trade. The only difference is you get more jingles in the intraday because you're risking less to make less. So the risk is always there, but you got to be very conscientious of what time frame you're in, see if game position-wise or if you're going to do it as a scalp. So I hope you enjoyed the video. It's a great video. Please review it, and thank you very much.